Hey guys, Dave Keller here with Market Misbehavior. So there's no denying that stocks are in a good place. The equity market's continuing to push higher with the S&P, the NASDAQ, Dow Industrials, Dow Transports, small caps all breaking out this week to new all-time highs. So I asked a number of my guests this week on StockCharts TV, what would you be looking for that would tell you that conditions are no longer so bullish? What would cause you to be a little more cautious or a little more concerned? So I've sort of taken some of the things that they share with me and put them into one chart. So here's the chart I would watch for market pullbacks. So with what I do on StockCharts TV, I host a closing bell show every weekday. And what I get to do 3 days out of the week is interview some really knowledgeable experts, strategists, technical analysts, and portfolio managers and ask them questions about how they're positioned and how they're approaching things. And when you have this situation where the S&P is going to new all-time highs, the NASDAQ's going to new all-time highs, a lot of individual names are rotating higher and breaking out of bases. Overall, the conditions seem pretty clearly positive. You combine that with the seasonal tendencies. Right now in November, December into January, some of the seasonally strongest parts of the year. So it always makes me think about the alternative hypothesis. What would I need to see to be less constructive, to be less optimistic? And I took some of the conversations I had this week and some of my own work looking at historical uptrends and combined those into one chart, which is what I'll be following to determine if and when this uptrend is exhausted, right? What would tell me that the trend is no longer positive? Before we get to the chart, I'd love to have you subscribe to my channel if you enjoyed this sort of thinking about technical analysis, behavioral finance, and investor psychology. So hit subscribe if you could. Also, give the video a like if you appreciate it. We would very much appreciate that back. Finally, put a comment below the video. Do you agree with the bullish thesis on stocks? And if so, why? If not, why not? Let me know in the comments below. Let's get to the chart. All right, so I actually used a version of this earlier and called it the chart. And so if you have one chart to look at, this would be the one. And I'll show you, I've adapted some of the indicators on here a little bit. But basically, all of the series on this chart are based on conversations I've had this week with people and in recent weeks, asking them what would cause you to be less bullish on the markets. And I find taking some of those suggestions, some of those ideas, and putting them in one place where you can start to see if and when the rotation happens can be a really helpful method. So let me talk you through what we're looking at. At the very top, you have the S&P 500 on a closing basis for the last 2 years. This is on a log scale, which is the way that you should be looking at long-term returns in any sort of asset class. Then we have 4 indicators to look at along with the price. And you'll notice all 4 of these right now are going higher. And that's why they are currently confirming a bull market phase. Number 1, we have the advanced decline line on the New York Stock Exchange. So this is looking at market breadth. The second one is looking at offense versus defense. Are people owning more consumer discretionary or consumer staples? Finally, the relative performance of the S&P 500 versus the utilities sector. Finally, new highs and new lows for the S&P 500. Let's look at each one of these in order. So the advanced decline line is the way of analyzing daily advanced decline data. How much are stocks or how many stocks are closing higher or lower on any given trading day? And you take that, a running total of those daily differences, and you combine those into a cumulative number. So this is why this line is called a cumulative advanced decline line. Now we're looking at the New York Stock Exchange common stock only, because on the NYSE, there are things like closed-end funds, some bond funds, that don't make a lot of sense to look at for an advanced decline line. You really want to just look at the individual stocks and whether they're closing higher or lower. So this common stock only advanced decline line, as you can see, had a really good positive run through mid-June. From there, the line actually sloped downwards. And then from mid-September through early November here, rotating back to test new all-time highs. So that upward trend in the advanced decline line is the first thing we're looking for. And what we would be wanting to see to be less bullish would be this line to rotate lower, which means on average, more stocks closing lower than closing higher on a given day. And really over time, that's more the trend. The second thing we're looking at is the equal weighted consumer discretionary versus equal weighted consumer staples. When I ran the technical team at Fidelity, we had a predecessor of mine named Bill Doan in the 1970s. I talked with him about looking at offense versus defense, and he had used a version of this, but with old indexes that are no longer available. So what we're looking at here is sort of an updated version of his offense versus defense ratio. And we're looking at an equal weighted consumer discretionary versus equal weighted consumer staples. And here's why. The cap weighted consumer discretionary ETF, the XLY, is really dominated by three stocks: Tesla, Amazon, and Home Depot. Those three stocks make up almost 50% of the ETF. So by looking at equal weighted ETFs, we take out the oversized impact of those mega cap names, and we're just looking more at the average consumer discretionary versus average consumer staple. So in general, are people more on offense or defense? Are they more on the offense side, things like luxury goods, retail goods, travel, tourism kind of names, or consumer staples, more defensive, things like alcohol, beverages, toilet paper, those sorts of things that you're going to need no matter what is going on around you. So what we can see is this ratio has actually been in a fairly consistent uptrend for most of the last year and a half, really since the March 2020 low. It's been favoring consumer discretionary. And it was sideways here in the middle part of the year, but really has rotated higher in the last couple months and really pushed to new all-time highs. So that tells you that given the option to be on the offense or the defense within consumer, investors are very much stepping on the gas pedal of the offensive side. When people start to get nervous, when investors start to get cautious and they get more defensive, this ratio is going to start to turn lower in a pretty big way. Finally, a lot of times I look at the relative performance of a stock or sector versus the S&P. Here we're flipping it over so that it's moving more in line with the other indicators we're looking at. This is the S&P 500 over the utilities sector. So if this line is going up, the S&P is outperforming the utilities sector. If it's going down, the S&P is underperforming. Now, the utilities sector is a very defensive sector. People don't usually want to own utilities unless they are doing one of two things. Number one, getting super defensive because they're nervous about the market environment. Number two, they're searching for yield because utility stocks, just like REITs and other sort of defensive names, a lot of times big blue chip names will pay a healthy dividend. So they're looking for yield. They're looking for income. But I found this ratio to be a good way of measuring sort of the risk on versus risk off trade. So if this line is going up, that tells you investors are in risk on. They're owning more of the S&P versus utilities. If the line goes down, that tells you investors are getting defensive, taking their foot off of the gas pedal, stepping on the brakes by owning a relatively defensive sector like utilities. So all three of those you can see are trending upwards. I would be looking for any of those to trend downwards, and that would tell you conditions are starting to change to be less bullish. The very final one at the bottom is looking at the new highs versus new lows. The green bars represent new highs for the S&P 500 stocks. Any red bars would be new lows. You can see we've had very, very few recently, but if you go back to like February, March of 2020, you can see what happens when a market stops going up, and you can see the new highs start to evaporate, and all of a sudden you see an increase in new lows. And that's what tells you a downtrend is really starting to happen. So more likely than not, usually I would guess that these other lines would rotate lower, and then the confirmation you would see would be some red starting to appear on the new highs and new lows list, showing you that some stocks are actually retesting their 52-week lows. And before that, you would see an evaporation in new highs as less and less stocks are making new 52-week highs. So that is the chart I would argue to watch for any sort of market pullbacks. At this point, the most bullish thing the market can do is go up. And the S&P making new all-time highs, the NASDAQ making new highs, the small cap index making new highs, all of those things confirm the fact that in the seasonally strongest part of the year, November, December, the equity market is firing on all cylinders. But I'm always looking for signs that things are not positive anymore. What would tell me to change my bullish positioning? This is a chart I would watch to look for changes in these sort of risk on versus risk off indexes that tells you when the market is no longer as constructive as it was before. If this sort of thinking about investor decision-making, behavior, market trends in history, and technical analysis is of interest, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you agree with my thesis that the markets are constructive here? Why or why not? Put a comment below and let me know. From everyone at Market Misbehavior, I'm Dave Keller. Be well, stay safe, take care.